Welcome to Honeycut Investment TV. In this episode, we're going to talk about Goodyear Tire. Now, the reason I decided to take a look at Goodyear is I saw a lot of bullish articles on Seeking Alpha and a few other websites as well on Goodyear. And most of the cases, it seemed to cite a few different factors: a low PE ratio, very strong management, and normally a lot of them cite also e-commerce and future growth opportunities. Let's do a quick overview of Goodyear. They're in the business of marketing and manufacturing tires. You probably knew that. They're a global organization, but about 38% of their sales come from North America. Another 37% from EMEA, which is normally just means Europe for the most part. And then the final 14% comes from Asia Pacific. And this is a company, if you had bought this company in 1996, you would have done very poorly. You would have a negative 25% return over that 19-year time frame. So that's awful. That is outright awful. And this is a company that struggled a lot through the 90s and the aughts, but it has turned around recently. So let's take a look at a few stats here. And the first one I'll look at is margins. And you can see that Goodyear's gross margins have improved over the years. Like around 2006, they were at 16%. In 2013, they were up at 21%. In 2014, 23.3%. So they're seeing gradual improvement on that front. This is complicated by a revenue decline, though. So they've actually seen revenues fall from about $19.5 billion in 2009. 19.5 in 2008, and it's fallen to about 18.1 billion in 2014. So that's the other side of it. Now, operating profit has improved a bit. So it's improved from about, let's say, 971 million in 2007. Now it's about 1.5 billion. So even though revenues haven't been doing they haven't seen much growth on the revenue side, they've seen good growth on the margin side, and that's leading to the fatter operating income. So for operating margin, you can also see the improvement here. They were hovering in the really they were down at the 1 and 3% range for a while. It got up to around 5% at times. But in the past couple of years, they're up at around 7 to 8%. In 2014, they were 8.3%. So they've really, at least they've doubled the operating margin percentage over the past decade. And, you know, it was very volatile then. In fact, they may have improved it more once you normalize those figures. One metric I particularly like to use, and especially with Goodyear, is normalized income. It's particularly vital for this company because Goodyear has a weird tax situation. I honestly cannot figure out what their tax rate is. You can see this chart here. Their taxes have been all over the place. I'm going to take a guess at 32%, but it's very difficult to discern. So what I did is I decided to normalize income. On top of the weird tax situation, they had a lot of one-time issues. And so based on this, I come up with normalized income of about $286 million in 2010. That figure jumped to $843 million in 2014. So that is impressive growth for Goodyear. Now, unfortunately, even though normalized income looks very good for Goodyear, there's another figure that I'm not too happy about, and that's free cash flows. Free cash flows for negative $800 million in 2014. Now, a lot of companies, you'll see a lot of volatility in free cash flows because of capital expenditures. You know, maybe they have to make a big investment one year, and that makes free cash flows look worse than they really should if you normalize it over a long term. I don't think that's the case with Goodyear, and that's one of my issues with the company. If you look at what's driving the poor free cash flow growth, it's not capital expenditures, it is pension contributions. So we take a quick look at this pension contribution expense. It was 1.13 billion, 1.16 billion, sorry, in 2013, and 1.34 billion in 2014. And these are very large numbers for Goodyear. And I don't think, a lot of people think these are just sort of one-time issues. I don't think they are. I think this is a big deal because Goodyear has a defined benefit pension plan. And the actuarial return is about 5.5%, which might not be realistic in an era where their 10-year treasury bond is only yielding, think about 2%, 2.9%. So it's completely likely that Goodyear's going to continue coming up short in the future. So let's look at the debt situation, and this is an area where there might actually be a net positive for Goodyear. I said that Goodyear's pension issues could be a drag on the company. The return they're going to make on bonds are probably not as high as their actuarial return for the pension plan. But at the same time, Goodyear has a lot of debt and they are not considered investment grade right now. And as we're seeing Goodyear's performance improve and they pay off some debt, I think it's possible that they move back into investment grade at some point in the future, and you'll see their interest rates fall as a result. So even though the pension contribution area is going to be a net negative, I think the debt situation is going to improve. They're going to be able to refinance at lower rates. That's going to be a benefit to the bottom line. I ran a few different valuation scenarios for Goodyear. As I'm doing this video, the price is about $30 per share for the stock. And here are my three valuation scenarios. My bull case valuation scenario puts the stock at 50. My cyclical bear case puts it at about 20. And then I have a most probable valuation around $34. So with the stock at 30, I have it slightly undervalued. It's not dirt cheap, and I would emphasize that I think there are some big risks with this company, but it does look maybe a little bit undervalued to me. All right, conclusion time. I think Goodyear is a reasonable buy at $30. It's not dirt cheap. It doesn't have a huge margin of safety, but it's reasonable. Biggest risk factors to me are the cyclicality. I think if we were to see a recession, this company would suffer more than average, and that's given where we are in the economic cycle, that would be something to be concerned about. And the other one to me is the pension plan. I'm not totally comfortable with that. I do think there's some really great things working in their favor though, and so I think the debt situation will continue to improve, and that'll be a tailwind. And management's doing a very good job right now. They're moving into more value-added sectors, increasing margins. I think management's doing all the right stuff. So I think that's a very good argument in favor of the stock. But overall, I would just say it's not a strong buy. It's a reasonable buy at $30. If it fell down to 20, I might consider it a stronger buy. All right, thanks for watching. I'll see you next time.